If you are new to investing but are wondering which stock to buy, legendary investor Warren Buffett has a suggestion: try buying 500 stocks instead. The S&P 500 index tracks the largest and most powerful companies in the United States. The constituent stocks are curated by the S&P Index Committee, which selects companies based on a host of factors, including market cap, liquidity, and sector allocation. In 1976, Vanguard introduced individual investors to the nation's first mutual fund designed to mimic the S&P 500 Index. 1. Some 20 years later, the first exchange-traded fund (ETF) was launched, which similarly tracked the S&P 500 Index. Today, nearly all major brokerages and fund companies offer some type of S&P 500 fund. Investors may access these funds through financial advisors, full-service brokers, or discount brokers. How do you invest in the S&P 500? An index is a measure of its underlying stock's performance, so you cannot directly invest in the index itself. Buying every company's shares would be an arduous task. Think 505 separate transactions, but thankfully there are index funds and exchange-traded funds, or ETFs, that replicate the index, effectively doing that work for you. While all S&P 500 funds track the holdings of this index, an investor must consider whether using an index fund, a passively managed mutual fund, or an ETF makes the most sense for them. The good news when weighing index funds versus ETFs is that there are solid S&P 500 options in each category, and all of these products leverage the diversity of the index itself. Because the S&P 500 is weighted by each company's market capitalization, the larger companies in the index can sometimes have an outsized impact on the performance of the larger index. In other words, a big dip in price for Apple shares can create a dip in the index as a whole. Because of this, some investors prefer to purchase the S&P 500 in an equal-weighted format so that each company has the same impact on the index. This is meant to create an index that is more representative of the overall U.S. market. After deciding your preference for an index fund or ETF, cap-weighted or equal-weighted, you can begin narrowing down which S&P 500 fund to purchase. To minimize your costs, look into each fund's expense ratio, the percentage of your assets you'll pay in fees each year, to see how they compare. Fees are important here since all of these funds track the same index, which means their returns should be roughly the same. The lower the fee, the more of that return you keep. Should you invest in the S&P 500? There are a number of things to think about before you choose any investment, but an S&P fund can generally be a good choice if you want to add broad exposure to the U.S. stock market to your portfolio. The S&P 500 is a key part of a diversified investing strategy because it's a good bet that the U.S. economy will continue to succeed and grow in the long term, says Tony Molina, Senior Product Manager at Wealthfront. The U.S. has the largest economy and stock market in the world and is one of the most resilient and active, especially when it comes to innovation. That's why it's a no-brainer to include the S&P 500 as part of your portfolio. Larger companies are generally more stable to invest in because they are well established and widely followed. Thus, these stocks usually have less risk and lower volatility. The S&P 500 combines large companies across various industries, so investors access a broad, diversified mix of companies when investing in it. Choosing an index fund or ETF can also help investors avoid, or at least minimize, the behavioral pitfalls from stock picking, which is a losing strategy, says Dejan Ilijevski, president of Sabella Capital Markets. Ilijevski cites the May 2018 study by Professor Hendrik Bessembinder at Arizona State University, which examined investments in publicly traded U.S. stocks between 1926 and 2016 and found that just over 4% of the companies accounted for the total wealth. Picking those few individual winners is impossible, Ilijevski says. Your best bet is to own as much of the market with a fund that tracks the index. Using index funds and ETFs can help investors generate strong returns while also minimizing their costs, says Kevin Kohler, chartered financial analyst and director of the investment strategy group at Miracle Mile Advisors in Los Angeles. Investing in the S&P 500 the past 25 years would have given an investor over a 10% annualized return, proving that an investor does not need to be paying high expenses to get good market returns, Kohler says. Are there drawbacks to investing in the S&P 500? There are caveats to consider. The S&P 500 consists of only large-cap U.S. stocks. Portfolio diversification encompasses buying mid and small cap companies along with large caps, allocating funds to international companies along with domestic ones, and including bonds, cash and potentially other asset classes with stocks. But relative to the downsides of many investment types, the flaws of S&P 500 funds seem relatively minor, especially when used as a part of your overall portfolio and held for the longer term. This helps explain why icons like Buffett have publicly endorsed them. I happen to believe that Berkshire is about as solid as any single investment can be, in terms of earning reasonable returns over time, said Buffett at the May meeting, speaking about the investing company he's turned into an empire.